Welcome to the course module devoted to ethical and governance issues associated with corporate financial management. In this video, we will be dealing with so-called agency problems, resulting in the potential for conflict between a company's management and its stakeholders. We will also describe typical corporate governance measures which are applied in order to minimize the risk of such conflicts occurring. In subsequent videos of the module, we will explain the concept of integrated reporting and discuss the ethical and environmental aspects of financial management in a business organization. Let's start by defining what an agency problem actually is. As you know, the main goal of any business organization is the maximization of shareholder value. However, shareholders represent just one group of a company's stakeholders. Other groups include the company's creditors, customers, employees, and local communities, whose interests should also be taken into account in the company's decision-making processes. In many cases, the objectives of different stakeholder groups may in fact be contradictory, and this may result in conflicts which have to be resolved by the company's management. A particular type of conflict, referred to as the shareholder conflict, is the one between the owners of the company and its management. The reason for this conflict stems from the separation of management from ownership. Typically, shareholders do not participate in the day-to-day management of the companies which they own, as this responsibility is handed over to professional managers who should act in the best interests of shareholders and other important stakeholder groups. However, as practice indicates, in certain situations, managers tend to act in their own best interest with the goal of maximizing their own wealth instead. It is interesting to note that agency problems exist not only in commercial organizations, but also in non-profit institutions, such as foundations and healthcare service providers. Although it may be expected that the morale of managers and employees in such organizations is higher than that found in strictly commercial entities, psychological research shows that acting in one's own self-interest is an immanent feature of human nature. It may therefore be concluded that the agency conflict can never be entirely resolved or eliminated. However, measures exist which can be put in place in order to reduce its impact. These include, in particular, performance-based compensation of managers and increased shareholder participation and influence when it comes to making strategically important decisions. We will be dealing with these measures later on in this module. Let's now take a closer look at some typical examples of conflicting interests among certain groups of stakeholders and the costs to the organization which they cause. A typical example of stakeholder conflict is the one that arises between shareholders and providers of debt financing. Shareholders expect higher returns than debt holders and may therefore apply pressure on management to undertake more risky projects. Debt holders, on the other hand, prefer projects generating lower risk because the return on debt financing is typically fixed, or at least not dependent on the ongoing performance of the business. This conflict generates increased agency costs to the company, such as those associated with loan covenants, which may restrict further borrowing, the payment of dividends, or asset acquisitions and disposals. Another example of agency problem is the conflict between employees and shareholders. For example, employees may oppose the automation of certain manufacturing processes for fear of losing their jobs. The costs of such opposition may take the form of strike action initiated by employees, but also loss of savings which the shareholders had planned to achieve from the automation. Conflicts may also arise between stakeholder groups which are not directly associated with the firm, for example, a company's customers and local communities. An example of such conflict arises when customers apply pressure on the company to reduce prices. The company may react by squeezing its local suppliers, thus exposing itself to negative publicity and unfavorable perception from local communities. As you may imagine, stakeholder conflicts are difficult to manage because the interests of certain groups are often completely contradictory. A commonly applied measure which enables the management of these opposing interests involves establishing a set of rules which define the hierarchy of decision-making referred to as corporate governance. Corporate governance may be defined as the way in which a business organization is directed and controlled. Its primary goal is to protect the interests of stakeholders and to ensure that the company as a whole acts in accordance with its values and ethical norms. The basic idea behind corporate governance is to balance the interests of a company's stakeholders, including shareholders, management, customers, suppliers, providers of finance, government and the community, by providing a decision-making framework which allows for the realization of the company's business objectives. Within the corporate governance framework, decision-making authority is distributed among the management and stakeholders. In particular, certain types of decisions may be taken by individual executives or the full board of directors, while others require the consent of the general meeting of shareholders. What is more, certain decisions may be handed over to dedicated committees within the company. In some companies, the rules of corporate governance also require that certain key decisions are consulted with other stakeholder groups, for example, employees. Let's take a closer look at how a corporate governance framework may be set up in a business organization. Typically, operational matters are decided upon by individual executives. For example, the Chief Financial Officer makes decisions regarding everyday financial management matters, the Production Manager regarding operational matters, and so on. However, individual executive directors are only allowed to decide within defined limits, and all decisions exceeding those limits have to be taken at a higher level, for example, by the full board of directors, to ensure that the views of all executives are taken into account when such strategic decisions are made. Some matters are exempted from the decisive power of the board and handed over to non-executive directors, forming the organization's committees. Contrary to executive managers, non-executives are independent of the company and can more accurately exercise their judgment in areas where executives could potentially experience a conflict of interest, such as management remuneration or accepting internal audit reports. Key corporate decisions, such as initiating new investment projects, appointing directors and external auditors, are typically reserved for the shareholders of a company who can vote on such matters at the annual general meeting of shareholders. As you can see, corporate governance is all about spreading the responsibility for company management by including various stakeholders in the decision-making process in a way which allows for the adequate handling of conflicts of interest, which could otherwise occur between different stakeholder groups. However, as you may expect, even the best corporate governance systems may fail without adequate monitoring actions taken by management and appropriate reporting. ensuring that decisions made within the organization are congruent with its strategy and values.